Hello and welcome to Chartered Accountant's Pen. Today I will briefly explain how revenue recognition for real estate developers is treated differently under IFRS 15 for accounting purposes and under Section 36 of the Income Tax Ordinance, 2001 for tax purposes in Pakistan. This topic is extremely important because many developers apply IFRS 15 in their financial statements, but face tax adjustments during audits by FBR. The key question we are addressing is very simple but critical. If a developer is preparing its accounts under IFRS 15, how should it file its income tax return in Pakistan? Should it redraft accounts using percentage of completion, or is there some alternative or legal workaround available? The answer lies in understanding the legal hierarchy between accounting standards and tax law. In Pakistan, the legal position is very clear. IFRS governs financial reporting, but taxation is governed strictly by the Income Tax Ordinance, 2001. Section 32 of the ordinance requires that income from business be computed in accordance with the provisions of the ordinance itself. This means that even if accounts are correctly prepared under IFRS, taxable income must still comply with specific tax provisions. So, accounting standards do not override tax law. Section 36 deals with income arising from long-term contracts. It specifically applies to contracts involving construction, manufacturing, installation, or related services. If a contract is not completed within the same tax year in which it commenced, the law mandates the use of the percentage of completion method. For developers, construction activity clearly falls within this definition. Therefore, Section 36 applies directly to real estate development projects. Under IFRS 15, revenue recognition is based on the transfer of control to the customer. Depending on the contract terms, a developer may recognize revenue over time, or at a single point in time such as possession or completion. In many cases, this results in delayed revenue recognition during early stages of the project. This accounting treatment may be perfectly acceptable under IFRS, but it creates a timing difference for tax purposes. Here lies the core conflict. IFRS the 15th of May allow revenue deferral, but Section 36 does not permit such deferral if the contract spans more than one tax year. The tax law requires income to be recognized based on actual progress of the project. As a result, income may be taxable even when accounting profit is low or even negative. This difference is purely a timing issue, but it has serious tax implications. The correct and accepted practice in Pakistan is not to redraft or restate the audited financial statements. Developers continue to prepare their accounts under IFRS 15 for SECP and statutory audit purposes. However, for tax filing, a separate tax computation is prepared in which income is recalculated under Section 36. This adjustment is made through reconciliation, not by changing the accounts themselves. Practically, the tax computation starts with accounting profit as per audited accounts. Then, timing differences are adjusted. Revenue and profit are recomputed using the percentage of completion method, usually based on the cost-to-cost approach. The resulting figure represents taxable income for that year. This reconciliation is what FBR expects during assessment or audit. Let's take a simple example. Assume a project with a contract value of 200 million rupees and estimated cost of 160 million rupees. If 40 million rupees have been incurred so far, the project is 25% complete. Under Section 36, 25% of revenue is recognized, resulting in taxable profit of 10 million rupees. This profit is taxable even if IFRS accounts show a loss or zero revenue. There is no general exemption available simply because a developer follows IFRS 15. The only exceptions are where a project is completed within the same tax year, or where it is expected to be completed within 6 months. Outside these narrow cases, Section 36 applies mandatorily. In practice, FBR offices routinely examine project-wise cost records and estimated budgets. They frequently add back deferred revenue and compute income under percentage of completion. Developers are therefore advised to maintain detailed project-level cost data and POCM workings to avoid disputes. To conclude, IFRS 15 governs financial reporting, but Section 36 governs taxation. Developers do not redraft accounts, but they must compute taxable income using percentage of completion. A proper tax reconciliation is not optional, it is a legal requirement. Understanding this distinction helps avoid penalties, audits, and unnecessary litigation. Thanks for watching Chartered Accountant's Pen. Please do subscribe, like and hit the bell icon for more informative videos.